All right, welcome back everyone for another deep dive. This time, we're taking a look at what some of the biggest investors were up to in Q3. We're talking 13F filings from 56 major firms. It's kind of like getting to peek behind the curtain and see what these Wall Street giants are buying and selling. Now, you might be thinking, why should I care what some hedge fund manager is doing with their millions? Well, the truth is, their moves can give us some pretty valuable insights.
Yeah, I mean, these filings aren't just about specific stocks. They can reveal broader strategies and trends, help us understand what these investors are seeing in the market.
Exactly. And we're not saying you should just blindly copy their every move, but learning from their approach can definitely give you an edge in your own investing. So one of the big things that jumped out at me from these filings is a trend I'm calling buy low, collect dividends. It seems like a lot of these investors are piling into companies that look undervalued, especially those with a history of paying out solid dividends.
Makes sense, right? It's classic value investing, finding those hidden gems the market might be overlooking. And with all the economic uncertainty out there right now, those dividends can be pretty appealing.
Totally, like a little safety net, right? So let's take a look at a company that fits this bill. Schlumberger, ticker symbol SLB. Now, I know oilfield services might not sound super exciting, but trust me, there's a lot to like here. In Q3, we saw 9 firms buying into SLB with only 3 selling. That's a pretty clear signal that there's some serious interest in this company.
And it's not just about traditional oil and gas. They're also doing a lot of cool stuff with digital solutions for the industry. Think about it, they're a $60 billion company. Their PE ratio is sitting at 13.71, and they're offering a 2.5% dividend yield.
So for our listeners who might not be familiar with those numbers,
Basically means SLB is potentially undervalued compared to its earnings, and they're giving back a decent chunk of cash to their shareholders.
so it's not just about riding the oil wave. It's about getting in on a company that's well positioned for the future of energy and getting paid dividends while you wait.
Right. It's like the best of both worlds. And there's another factor. We can't ignore the political landscape. There's a lot of speculation about a potential Trump return, which could lead to some policy shifts that would benefit the oil and gas sector.
Oh, that's a great point. So it seems like investors are betting on SLB as a solid long-term play. Buy on the dips, hold tight, and enjoy that dividend income. Now, another company that's attracting similar attention is Citigroup, ticker symbol C. This global banking giant is trading at a remarkably low valuation.
Yeah, their price-to-book ratio is just 0.62, which is significantly lower than many of their peers.
And they're offered a 3% dividend yield, even better than SLB. But I gotta ask, with valuations this low, is there something we're missing? What are the risks here?
You're right to be cautious. Even with cheap stocks, there are always risks. In Citigroup's case, their exposure to the commercial real estate market is a concern. Think about all those empty office buildings and struggling shopping malls. A downturn in that sector could hit banks pretty hard.
Right, that makes sense. So even though Citigroup looks tempting with that low valuation and high dividend, we need to remember that it comes with its own set of challenges.
Absolutely. Got to look at the whole picture before making any decisions.
Okay, so we've got SLB and Citigroup, both seemingly undervalued with attractive dividends, but they're not the only ones fitting this buy low trend. How about Wesco International, ticker symbol WCC? They distribute all sorts of electrical equipment and lighting systems, the stuff that keeps the lights on in our modern world.
Wesco is interesting because they're not as much of a dividend play. Their yield is only 0.82%. But their appeal lies in their potential for long-term growth. As the world becomes increasingly electrified and connected, Wesco is well-positioned to benefit.
So instead of that immediate dividend income, investors are betting on Wesco's future growth prospects.
Exactly. They're kind of like the picks and shovels during a gold rush. They provide the essential infrastructure, regardless of which specific technologies win out.
Love that analogy. Okay, and one more company that caught my eye, JD.com, ticker symbol JD. This Chinese e-commerce giant might ring a bell. They're the ones behind those massive singles-day sales we hear about every year.
Ah, yeah, JD.com. They're a bit of a mixed bag. Their revenue growth has slowed down recently, which might explain why some investors have been overlooking them.
But their cash flow is incredibly strong, and they do offer a decent 2.27% dividend yield. Plus, their Q3 net income growth was a whopping 47.8%. It's going to be a good sign, right?
It does suggest that they're managing their operations very efficiently. So, while revenue growth might be slowing, their profitability is actually increasing, which can be very attractive to investors.
Okay, so we've got 4 companies here: SLB, Citigroup, WSCO, and JD.com. They're all being viewed as potentially undervalued. but for different reasons. Some are dividend plays, others are long-term growth stories, and some are a mix of both. It seems like there's no one-size-fits-all approach to this buy low trend.
You got it. And that's what makes this deep dive so valuable. We're not just looking at individual stock picks, but understanding the broader investment philosophies at play. And that's what we're going to keep doing as we move on to the next part of our analysis.
Absolutely, stay tuned, folks. We'll be back in a moment with more insights from the world of big investors, and trust me, you won't want to miss it.
It's going to be good.
Yeah.
So while some investors were out there hunting for bargains, others were taking a different approach. Kind of the opposite, actually. We're talking sell high, trimming positions in some of those market darlings, companies that have been on a roll for years, but maybe showing some signs of slowing down.
It almost feels counterintuitive, right? Selling off companies that are still doing well makes you wonder if they're just locking in profits. Or maybe sensing a change in the winds.
Yeah, it's a good question. Because even the most successful companies, they can become overvalued. And when that happens, savvy investors, they start looking for opportunities to rebalance their portfolios.
Yeah.
Maybe rotate into something with more upside.
Makes sense. So who's getting this sell-high treatment? Give us the names.
All right, well, one of those notable examples is Apple, ticker symbol AAPL. Now, Apple, phenomenal company, no argument there. They've revolutionized so many industries, and they've got a customer base that's incredibly loyal. But even with all that, their valuation has gotten a little, well, stretched.
Yeah, I see what you mean. I mean, a high valuation isn't necessarily a bad thing on its own, but it does make you wonder how much more growth is really possible. Is there a limit to how many iPhones and Macs they can sell?
Exactly. And some investors seem to be taking a more cautious approach, like Warren Buffett, for example. He's been steadily reducing his Apple holdings over the past few quarters. In Q3 alone, he sold off $2.5 billion worth of Apple stock.
Wow, that's a big move from someone who's known for, his long-term investment strategy.
It goes to show that even with companies like Apple, you got to reassess your investments regularly, see if the current valuation still aligns with your expectations for growth.
Right, a good reminder for all of us. Okay, so Apple's seeing some selling pressure. What other companies are experiencing similar trends?
Well, United Health Group, ticker symbol UNH, and Berkshire Hathaway, ticker symbol BRKB. They both saw some significant selling in Q3. The main driver seems to be their high valuations.
So it sounds like valuation is playing a big role in this sell-high trend. Investors getting cautious about those pricey companies, even if they have a strong track record.
Yep. And it's not just individual companies either. We're also seeing a broader pullback from high valuation tech stocks. Companies like Meta, ticker symbol Meta, and Google, ticker symbol GOG, haven't been immune.
Is this the beginning of the end for big tech's dominance? Or just a temporary blip? What do you think?
It's hard to say for sure. It could be that investors are just taking profits after such a long run-up in tech stocks. Or it could be a sign of a more fundamental shift, with investors looking for opportunities in other sectors.
Lots to think about there. So we've got investors seeking value, others taking profits. But I'm guessing it's not always that clear-cut, right? There must be some companies sending mixed signals.
Oh, absolutely. And one company that stands out as a bit of a puzzle is Salesforce, ticker symbol CRM. They had 7 buys versus 2 sells in Q3, so strong interest from investors. But here's the thing, their valuation is sky high, price-to-earnings ratio around 55, way above the market average.
That's a head-scratcher. You'd think investors would be hesitant to jump on board, especially with that sell-high trend we've been talking about.
Right, so what's driving this interest in Salesforce? Well, a lot of it has to do with their push into artificial intelligence. They launched their own AI assistant, created a lot of buzz in the tech world.
Ah, yes, the AI hype machine. Seems like every company is trying to get in on the action these days. But the question is the excitement justified?
It's the million-dollar question. Got to look beyond the hype. See if a company's AI initiatives are actually leading to revenue growth and profitability. And in Salesforce's case, their revenue growth has been slowing, hovering around 8%.
So are investors betting on a future where AI drives significant growth for Salesforce, even though the present picture is kind of mixed.
Seems like it. Definitely a risky bet. Highlights the importance of doing your own research, not just following the crowd. What looks like a sure thing to some could be a gamble to others.
Very true. So Salesforce is defying the sell-high trend, at least for now. Any other companies bucking conventional wisdom?
Well, General Motors, ticker symbol GM, might not be the flashiest company, but they had a strong showing in Q3. 7 buys and only 1 sell.
GM? Really? What's sparking investor interest there? Did they suddenly become a tech darling?
Not quite. But they are making some strategic moves. Their valuation is incredibly low, PE ratio of just 6, practically unheard of in today's market.
Okay, that's definitely attention-grabbing. But a low PE ratio can also be a sign of trouble. What's the story with GM?
Well, they've been facing some headwinds in recent years, especially with the rise of electric vehicles and the shift away from those traditional gasoline-powered cars. But they're adapting by investing heavily in EVs themselves, implementing cost-cutting measures to boost profitability.
So these investors are betting on a GM comeback. Huh? They like that low valuation and the potential for growth in the EV market, plus GM's commitment to becoming more efficient.
Yeah, but is it a sure thing? The auto industry is, well, it's unpredictable, and there's no guarantee that EV demand will stay this strong. So is this a short-term opportunity or a long-term gamble? That's the question.
It's really interesting to see these different strategies playing out. We got investors searching for value in companies like SLB and Citigroup, while others are taking profits on those high flyers like Apple and UNH. And then we have these outliers like Salesforce and GM, where investors seem to be making bets on future potential, even though there's some uncertainty.
It really does kind of paint a picture of a market that's in transition. After years of strong growth in tech and those high-growth sectors, investors are weighing their options more carefully these days, looking for value where they can find it, but also being more selective about where they put their money.
Feels like we're at a crossroads. So for our listeners out there, what are the key takeaways from all this? What should they be thinking about as they navigate their own investments?
I think the biggest takeaway is that there's no one-size-fits-all approach. What might be a great opportunity for one investor could be a disaster for another. It all comes down to individual risk tolerance, investment goals, and time horizon.
So true. It's not about blindly following what the big investors are doing. It's more about understanding why they're making those moves and then applying those insights to our own individual situations.
Exactly. These 13F filings can be a great tool for understanding market trends and what investors are thinking, but they're just one piece of the puzzle. We also need to do our own research, stay up to date on what's happening in the economy and the world, and be prepared to adapt as things change.
This deep dive has definitely given me a lot to think about. I'm curious for you personally, what was the most surprising or interesting trend you noticed in these Q3 filings?
What really stood out to me was this sense of cautious optimism that seemed to be pretty common. While some investors are pulling back from those high-growth areas, they're not exactly panicking. They're
Yeah.
still finding opportunities in undervalued companies and those dividend-paying stocks and sectors that they think are poised for growth in the future.
I see what you mean. It's not a full-blown retreat. It's more like a strategic shift. Makes sense given what's going on in the economy and the world right now. We're facing some uncertainty for sure, but there are still opportunities out there for those who are willing to put in the work.
Exactly, and that's what makes investing so interesting. It's a constant process of learning and adapting and making those decisions based on the best information we have.
Couldn't agree more. And remember, everyone, this deep dive is not financial advice. It's all about exploring how investors think and those forces that are shaping the markets. The best investment decisions are always the ones that are well-informed and align with your own personal goals and your risk tolerance.
Well said. And as we wrap up, I want to leave our listeners with something to think about. Do you think this shift towards value is just a temporary thing, or is it the beginning of a longer-term trend? And how might that affect your own investment strategy going forward?
Great questions. The answers will unfold as time goes on, but by staying informed and engaged, we can all navigate these markets with a bit more confidence and clarity. Thanks for joining us in this deep dive. We'll catch you next time.